And we should be live. Welcome everybody to the Farmland LP Fund 3 update webinar. I am Adam Taggart, host of Thoughtful Money. Most of you watching this may recognize me. You've probably seen Craig on the Thoughtful Money channel a couple times in the past, perhaps as most recently as Thoughtful Money's Fall Online Conference just a week and a half ago. At the conference, Craig mentioned that his Fund 3 was still open for investors, but likely closing to capital by the end of this year. And so we talked about having him come do a Fund 3 presentation for the Thoughtful Money audience, which he is doing here. If you're watching this live, welcome. In the live chat, I see some of you have already started. Please let us know where you're watching from. That's always really helpful. And if you can't watch for the whole hour plus that we're doing this, don't worry, a replay of the video will be sent to everybody who is registered for this conference so you can watch the rest later. I am joined by Farmland LP Managing Partner, Craig Wichner. Craig, my friend, how you doing?
Doing great. Great to see you.
Great to see you too. Love to see you. Outstanding in the field there. I know that's a shot from actual Farmland LP property. All right, so folks, this is going to follow basically kind of a three-part format. And again, I'm just the MC today. But Craig will start us off by giving an update on farmland as an asset class and how it tends to perform in general, but certainly perform relative to other asset classes. If you watched the online conference a week and a half ago, you might see some repetition here, but I think that's always good when you're learning about a class to invest in. Next, Craig will get into the details of Fund 3. So he'll talk about the Farmland LP model. He'll talk specifically about what's the opportunity is with Fund 3. Tell you, if you're interested in investing, how to learn more, all that. We'll give you all the information to your heart's content. And then the third part will simply be live Q&A. And I will field as many of your questions as Craig has stamina for. So Craig, that sound good?
Sounds great. And of course you can ask any questions along the way.
Thank you. I may jump in, hopefully just to for clarity's sake, but I'm going to try not to interrupt Craig's flow too much because he has prepared what I understand is a wonderful slide presentation for you. So I guess without further ado, Greg, feel free to take it away.
That's great. It's also a fun asset class. It's fun to talk about. And I think it's, generally relevant for people as well. So again, yeah, it's always fun to talk about. The slides get to keep us on track if we ever get off, but feel free to ask questions.
Okay, well, I'll bring them up now. And again, folks, I should have mentioned this before. Not that this should influence you in any way, shape, or form, but I am an investor in Farmland LP's Fund 1 and Fund 2. I have not invested in Fund 3 yet, not for any reasons that related to what Craig is talking about. As many folks know, my family made a big move this year. We're a little cash flow poor, but still hoping maybe squeak in by the end of this year. But I did want to make it known that even though I'm just the MC today here, I am an investor in the Farmland LP family of funds. So with that, Craig, I will bring up the slides and I'll let you take it away.
Great. And I think you've been to the vineyards up in Oregon that we have, and then you've also been out to the blueberry farm that we have as well for Family Day. So there's a lot of fun things about the asset class, and it's great to have you.
Thanks. Well, yeah, I've been to Burns Farm almost since year one. It's amazing to see how that property has evolved.
Yeah, and we'll talk more about that kind of towards the middle. So great to talk with your audience. I'm an audience member for a long time as well, and so it's great a little bit to be on the other side of this. Just to share a little bit about Farmland LP, we buy conventional farmland and we convert it to organic, regeneratively managed farmland as an investment fund. We are a farmland investment manager. We add value by converting it to organic, converting it to regenerative agriculture, converting it from low value crops to high value crops. We manage over 300 million, about $350 million in farmland, just about almost 20,000 acres. We've been doing this for 16 years. And we have a great team as well, 11 people in fund management and 55 people in farmland management. the key thing that we've proven with our business model is that we buy high quality farmland that's growing low value crops, and then take it through a 3-year organic conversion period, and then get rents of $775 an acre. So the farmland grows higher value crops. It's more profitable for both the farmer on that land as well as for the fund. Generally, profits are roughly split 50-50 between the farmers and the farmland owners in general. So that's a nice benchmark. Fundamental premise: if you can grow higher value crops on that land, that makes more available to everybody. We have again, been doing this for 16 years, and so have a lot of recognition. In fact, this last year, we were recognized as the Farmland Fund Manager of the Year by Agri Investor, so we're happy about that, but also been recognized on Bloomberg and New York Times and other things as well. Farmland as an asset class, it's an interesting and kind of not misunderstood, but people aren't very aware of farmland as an asset class. There's almost $4 trillion worth of farmland in the US, and that's about the same economic value as all of the apartment buildings in the US and all of the office buildings in the US. But only 2% of farmland is institutionally owned, unlike those other asset classes, which are predominantly institutionally owned, especially at the larger scales. So, but another interesting thing about farmland is that there's only, whereas apartment buildings are over 50% leveraged in general as an asset class, office buildings have over 78% debt on the asset class, or more, depends on what you think the value of office buildings are today. The farmland, there's only 13% debt on the entire farmland sector. So what that means is that if there are ever any credit issues or debt market issues, you're not going to have a bunch of farmers being forced to sell their farmland and drive those prices down. That's one of the key things that makes it a more resilient and uncorrelated asset class compared to even the other real asset classes, let alone the stock market. And again, only 2% of farmland is institutionally owned. So when you hear about Bill Gates owning a large chunk of farmland in the US, that's still a fraction of what's considered the institutional ownership in the space. And that's about 5% of his net worth.
Hey, Craig, sorry to interject. So the majority is really just small family farms or family farms of various sizes?
Of various sizes. So you do have, in the US, 40% of farmland is leased. Very similar, or nice comparison in terms of the percentage that's leased to some of the asset classes. So it really is commercial real estate on there. And in terms of the actual farmers who own it, usually it's very large families or even farming companies that own and operate it, but not the institutional investors.
Okay. All right. By the way, folks, there were some people commenting on my audio. I think I fixed it. If I did, please let me know in the comments there in the live chat. Sorry, Craig, proceed.
No problem. So a key driver of farmland as an asset class is that the total amount of farmland is declining as the other asset classes, the other real asset classes, for example, expand as housing grows or industrial properties grow. You see those Amazon buildings or Walmarts continue to expand. They're building on farmland. And that's driving the supply of farmland down. Meanwhile, the population continues to increase, and that creates more pressure, more demand for the crops that come off of farmland. And that results in very long-term consistent returns from farmland, both from appreciation and from cash flow. In fact, over about the last 85 years, the returns from unlevered farmland have been about 11% per year, about half from cash flow and half from appreciation. This shows you returns over the past kind of almost 30 years or so. Asset appreciation on the left, and cash flow rents on the right. And again, this is across all farmland. 53% of U.S. farmland grows 2 commodity crops, corn and soy. So a lot of the numbers you might hear are kind of predominated by those commodity crops. But as you get, for example, to the West Coast, instead of like kind of the 3 main crops, corn, soy, and wheat, grown in the Midwest, on the West Coast, for example, there's over 300 crops that are grown there. So a lot more crop diversity and a lot more opportunities to increase the value of crops that are grown on that land. If you compare farmland to other asset classes as well, if you're a kind of an institutional or professional investor, the chart on the left is going to make sense. If not, it might be a little confusing, but at the bottom is volatility. So as you go out to the right of that left chart, as you go out to the right, you're increasing volatility, and as you go up the chart, you are increasing returns. And what you see there is that farmland is actually a low risk, low volatility item that generates high returns compared to commercial real estate, compared to the S&P 500 and other asset classes. And on the right-hand side, you see a chart. S&P 500 is very volatile. And then you see commercial real estate in general. It's the purple line that has some significant drops when the market is highly volatile, when the credit markets have issues. But you see farmland is really that slow and steady, that tortoise that wins the race over the long haul. It's one of the reasons why I like it so much. Another thing that's nice about farmland is that farmland beats inflation by about 6%, a little over 6% per year, looking at it on a decades basis. The key thing about inflation is the rising price essentially for consumers. Food is a key input to that. As food prices increase, the value of the crops grown on an acre of land increases, and that increases cash flow to the farmer and to the landowner as well. So really, when you're investing in farmland, you're investing on the side that really benefits from the rising prices as well. Let's look at market perception. So on the one hand, farmland is really a very attractive asset class for accredited investors. You do see significant amounts of capital coming into the sector. Again, very small compared to the overall size of the sector, but the relative amount of capital that's been coming into the sector really has been growing, and it's recognized by the media. So you're going to hear some very good things in the media about farmland. Also, right now, you hear about short-term pressure on farmland. So, for example, over the past year, you see bankruptcy filings double on farmland. Bankruptcies are really quite rare in agriculture because of all the government support, but there is pressure in the sector, and that is causing some increased bankruptcies as well. And so the pressure that's on agriculture right now, high input costs, especially the fertilizers and pesticides that are coming in to the country. Tariffs are causing issue with crop sales. Higher interest rates are putting pressure on the farmers that do have leverage, which is actually primarily the institutional investors, and lower commodity crop prices, in part driven by those tariffs, which really have cut off the export markets for us. So that's putting pressure on some farmland. On the other hand, farmland is still very resilient. So generally, there's a historic scarcity of farmland. There's that strong and growing investor demand for the asset class. It does provide that that inflation protection, and it's generally sold with a kind of built-in illiquidity discount. So because it's not a publicly traded asset, you're already buying it kind of at a low resilient price. That means that there's kind of generally pressure. All these other factors just kind of naturally drive it up. How does farmland fit into your portfolio? This chart really looks at the different asset classes that investors have as they kind of tier up in wealth. And I'm just going to look very quickly. I'm going to steer your eyes towards that $10 million line. And the first thing that I want to say is that of that $10 million net worth line, about 4 million of that is people's businesses. When you think about your portfolio, you're generally not lumping in the business that you own or you have a nice piece in. You're generally thinking about your investment portfolio. So that's maybe leaves about $6 million there. The other thing is that your primary residence, the red box, is also included in this particular analysis. So let's call that roughly another $1 million. So that basically leaves about $5 million of what you might relate to as your investment portfolio. And in this report, about $1 million or 20% of that investment portfolio is in real estate. And that's actually pretty close to the 24% of real estate and real assets that advisors have. That advisors who manage people's portfolio is about what they put it in for the institutional investors. So that kind of 20% is a really good benchmark for the illiquid real assets. And people like Bill Gates, for example, have 5% of their allocation to farmland. So why do people invest in these real assets? This shows you on the left the average annual return to the Russell 1000 in the 4 worst years. And what it shows in that second to top box there is that private real estate. There's managed features, private real estate, mezz lending, et cetera. And then towards the bottom there is the US large cap market. If you look at correlations with the other asset classes, again, private real estate is very uncorrelated at 0.22, whereas large cap is about 0.5. It's very correlated with the other asset classes. If anyone is invested in the stock market today, I'm sure that you're more highly weighted on the U.S. side because it's been, for the large cap side, because it's been doing well. That's a good time to diversify. So institutions lead alternatives allocation. So if you are an institutional investor, your allocation to alternatives is about 24%. If you just have a normal kind of wealth manager on the street, the average advisor, you're probably going to have about 6% of your assets allocated to alternatives. So in general, people should be increasing their allocation to real assets about 4-fold. Farmland LP strategy. So here's the fun part. So farmland, if you kind of look at it as its constituent parts, is really sunshine, dirt, and water. So sunshine is great growing environment. Dirt is high quality soil that has the capability of growing higher value crops. And then water is both physical access to water as well as legal ownership of that water. And those things combine really to make up farmland, and you can value each one individually. And that's what you're getting access to when you're buying farmland. If you don't have water, you really can't grow crops. And water is a key part of our strategy. We'll talk about that. When you look at it that way, we set up Farmland LP to do something very simple, basically acquire high quality farmland, add value to that farmland, and then actively manage that farmland on an ongoing basis. So we already talked about the kind of farmland that we buy. Adding value is converting that to organic farmland, converting that to higher value crops, could be planting permanent crops or acquiring things like blueberries or wine grapes, etc. And what that results in is a diversified portfolio with economies of scale. It's uncorrelated and is industry leading as well in terms of the other benefits that you get. So biodiversity, water, soil carbon sequestration, and some other things. There'll be some interesting news coming out around the soil carbon in the next couple of months.
Hey, Craig, if I could just chime in for a second. Forgive me if I slept and missed it somehow. Did you previously show the slides that show the paucity of organic acreage in the country?
I did not show that slide.
Okay.
Let me see if we have it as a. Oh, I have that slide as an extra one at the end.
Great. So, I'll let you determine when you want to bring it up, but this is the point where I just want to make folks who aren't super familiar with Farmland LP's model really fully understand kind of the core of what you guys do, which is, and correct me if any of this is, if I'm saying it incorrectly, Craig, but you guys are essentially finding cropland that had been conventionally farmed, usually with a monocrop, right? And that type of farming approach is low margin generally, and it sort of strip mines the soils of its nutrients, which is why you need those fossil inputs and you need those pesticides and everything. You need to keep adding them to the soil year after year because you're stripping them out year over year, farming it conventionally. You are then, Farmland LP, you're coming in, you're taking what we'll call land with great bones and great water access and stuff like that. And then you are essentially converting the soil to organic status, which is a multi-year program. I'll let you give the details of it. And then you are raising organic produce on it, which commands a much higher price point. So it's a much higher profit margin. As you said earlier, you tend to produce a much greater selection of output off of that land than what was previously coming off it when it was largely just a monocrop. But really importantly, I think to at least some category of investors here is yeah, the economics are great too, but I'm also like healing the land. We are building layers of rich micronutrient rich topsoil year over year. We're using natural processes to deepen rich topsoils versus the strip mining approach. Did I capture it relatively correctly?
You did a great job. You want to do the rest of the presentation?
No, not at all. I just wanted to make sure that light bulb turned off in everybody's head. And then to this point here, which you can talk to the data, Craig, is because you're growing, your focus is organic output. There is such a supply-demand imbalance in the US and the larger world right now, where the demand for that organic product is multiples more than current supply, and that imbalance will likely exist for quite a long time because there are so few organic acres relative to the US population.
That's great. Adam, can you switch over to the PDF that I just uploaded?
Absolutely. Hold on one second. Is that this one?
There we go. The graphics were just a little bit off on the PowerPoint, so this is a little bit more clear here. And thanks for explaining that so well. This slide, the slide that the part that Adam's referring to is the part on the right here, which is the top line, the purple line, which is the growth of organic food demand. And so the organic food market is over $60 billion, nearly $65 billion a year. That's about 10% that's about 6% of the US food budget on there. And that's growing at about 12% a year. So very strong dynamic growth on that. The problem is that, for example, Costco sells about 10% of the organic food in the US. And what the CEO of Costco recently said was that they can't get enough organic supply to keep their shelves stocked day after day to serve the organic demand. And so what that means is that the market would actually be larger if there was more organic food. The big thing that's holding back organic food growth is actually you need certified organic farmland in order to grow organic food. And it takes 3 years to get farmland certified organic. And it's a somewhat challenging process. So only a little over 1.3% of U.S. farmland is certified organic, and it's only growing at 6% per year. So the growth of the supply of organic farmland is just simply not keeping up with the demand for organic food. And that's really fundamentally what our core business is about: buying high quality farmland, growing low value crops. Our investors help us fund that 3-year organic conversion process so we can make it available to other farmers so that they can grow high value crops. And we do some farming ourselves, but I'll talk about that on the next slide.
All right, fantastic. So, sorry to interject, but I just wanted to make sure people really got that about the fund before you went into the fund specifics.
That's great. Let's see. And that's a perfect segue to, actually, we'll go back to that presentation.
Oh, we could go back to the PDF if you like.
Oh, that's fine. If there's something messed up, we'll go back, but this is great. Okay. So Adam, this is a farm actually that you've been to. And so this is a farm from Fund 1. And Fund 1 bought this farmland for around $30 million. It's about 4,000 acres of farmland, growing the same 3 crops for basically 150 years, had 2 farming tenants on it, growing alfalfa, corn, and tomatoes on that land. So we purchased it, and today we bought it for $30 million. Today it's worth around over $90 million, $91.8 million. So 3x increase in value. About 80% of it is in organics and permanent crops. We took it from 3 conventional crops to 12 diverse crops on there, from 2 farming tenants to 7 farmers on that land, and from a little over $300 an acre gross margin per acre on that to over $1,300 gross margin per organic acre and permanent crop acre on that land. So very substantial increases in value. You can see the chart on the right-hand side, which shows the crops that we're growing today. Except for the first line, we actually grow the organic blueberries at cost for the benefit of our investors. Everything else is leased land there. So $775 an acre flat rent for the organic vegetable acres. We have our organic farmers on average, our tenant farmers lease on average 1,000 acres of land each. So this is not, we do have some small farmers as well, but really we're helping those already successful farmers increase their acreage so they can serve their customer demand like Costco or Whole Foods or whoever else. And the people who work with them get the experience so that as they get more experience, then they can go off and start their businesses. They can lease small amounts of farmland, be successful and grow their land. And of course, they'll be buying their own farmland and expanding that as well. You want to say something, Em?
Yeah, I do just want to chime in real quick. So folks, if you are looking at this just with your blind dollars and cents investor eyes, the thing I just want to point out here, at least this is the way I think of it that way, is look at your 2.3 times gross margin per acre, right? So through everything that Craig and his team do by coming in and bringing the land up to organic status and growing these higher value crops and a greater diversification of them, you get greater gross margins, right? You're getting cash flows off the land that are far greater than what the land was doing before. And you're getting it with some risk reduction because you've got greater diversity of product. So if, one crop falls out of favor one year, well, hopefully the other ones that are growing there make up for it. Now you're also getting, in addition to that cash flow, increased cash flow, you're getting the land appreciation, right? And farmland that is organic with deep, rich, healthy topsoils is likely going to appreciate at a far faster rate than a conventionally, managed property. And then third, you're getting the water rights in their appreciation as well in here. And Craig, I'm sure you're going to talk about that at some point in time. But when I look at it just as like a Machiavellian, what's in it for my wallet, those are the key things that I think of. Now, of course, if you're more mission-minded than that, you've got the improvement, the healing of the soil as part of it. But you've got the other part that Craig was talking about too, where you are providing more jobs for the communities that these farms are in. And Craig, correct me if any of this is wrong, but I think I got the script down. So whereas you had fewer farming tenants, now you've got many more farming tenants because they're farming all sorts of different types of products. So you're supporting the local community there. You're giving more farmers an entry point. Another thing that you guys are doing, because you're kind of the landlord of the farmland, is you are making capital investment decisions, right? So you talk about adding drip irrigation here. You've mentioned to me in past conversations, Craig, about all the infrastructure improvements you guys have put in, whether it's remote satellite monitoring, whether it's new fuel pumps to get the water going through the property better. You're putting in hedgerows for natural pollinators and natural animals that help keep the soil healthy. And so these are investments that small farmers can't usually make in the land that they farm, especially if they don't own it, right? So you're giving these farmers not only an entry point, but you're giving them access to much better farmland to grow their crops or ranch their animals than they otherwise would have. So there's a lot in here, whether it's for your wallet or whether it's for your love of the environment and how our food production system, supporting the food production systems you want to see, that I think wrap into the total return. So I'll shut up here, Craig, but I just wanted to make sure that folks, again, kind of got all that.
That's really great. I'll just phrase it a different way, in that if you look at it in a black and white way, it has to make economic sense. And it's a multicolor asset class. If you care about the organic and regenerative agriculture, or if you care about increasing farm worker income, or all these other things, there are a lot of extra benefits that are delivered by having farmland be managed from a biological focus as opposed to a chemical focus. Mm-hmm. So that's a key part of it. On the point about investing in the farmland, so 40% of farmland is leased, and most of the people who own that farmland, maybe their grandparents were farmers or great-grandparents were farmers. They live in the city, but they're not doing any CapEx investments on that land. When we bought this property for almost $30 million, there was about 400 acres that was growing basically low-value dry crops like grains and wheat that really wasn't generating much economics at all. It's like, why are you guys irrigating that and growing higher value crops? And well, we don't have enough pump capacity to do that. Well, how much would it cost to get pump capacity to irrigate those 400 acres? Well, about 40K on that. So for 40K, I can get an extra 10% farmland productivity and irrigated crops. Yep, that's about right. Done. So there's these opportunities to actually really kind of do these very smart CapEx investments that overcome deferred maintenance. But then there's these opportunities as well to take farmland where it was generating $300 an acre, growing commodity corn, to this year we identified about 600 acres of land about 5 years ago that was great for organic blueberries. We had some experience in blueberries. We set up a partnership with Driscoll's. Those are now really coming into fruition. They are still increasing increasing their production. But this year, we produced 3.5 million pounds of organic blueberries at a gross margin of $3,400 an acre. So wow. Significantly higher than all these other crops, and that will continue to grow on there. We love working with Driscoll's. We love growing the organic blueberries, and this will generate very nice returns for investors as this continues to increase as well. So we lease out right now about 2/3 of our acres. We farm about 1/3 of the acres ourselves, really kind of balancing that risk and return.
All right, fantastic. And Craig, I'll let you continue. Just two things. One, folks are asking a whole bunch of questions about the economics of the fund and whatnot. Folks, anything that you're asking that Craig doesn't get to in the actual official slide presentation here, we'll get to in the live Q&A. And then lastly, I just want to mention on this infrastructure point, Craig, I believe in a surprising number of cases, the government is stepping in to actually give you grants and help you make those investments because they want farmland to be more productive in America, correct?
We get grants to convert from flood irrigation to drip irrigation. Drip irrigation is one of the best things you can do to improve the economics of your farmland. You get higher yields, and especially in organic production, you're not irrigating the aisles. You're just irrigating the crops. So your weed pressure and your weeding costs go way down as well. They pay us to put in hedgerows and pollinator habitats. Yeah, so there's a lot of government support in addition to the crop insurance. So,
great. So nice to be in a sector where the government is actually a tailwind for you and not a headwind.
I wish I had that in my apartment buildings, but yes.
All right. I'll disappear again.
Great. Let's talk about Fund 3. So we, again, have been doing this for 16 years. 2 years ago, we started Fund 3. So new investors coming in to buy new farmland. We had a lot of actually Fund 1 and Fund 2 investors come into Fund 3 as well. And actually, Adam, can we go to the PDF there? Because
yeah,
Ian,
no problem.
Ian put some very nice icons. There we go. So those pretty little pictures next to
yeah, we couldn't have done it without those icons. Good call.
Exactly. And Ian worked to put those in there. So we've raised over $100 million, already deployed that capital, bought over 4,800 acres of farmland growing a variety of crops, blueberries, almonds, apples, cherries, hazelnuts, vegetables, tomatoes, and wine grapes. That vegetable ground is actually already in organic conversion, so it's technically transitional now. So we've bought that land and we've really hit the ground running in terms of increasing the value on that land. And it's regionally diversified across Northern California, Oregon, and Washington. One thing I want to say about our strategy, which is kind of different than everyone else, is that we don't just buy a piece of farmland and then lease it back to a farmer or lease it out to new farmers. We're not doing it kind of all around the country. Economies of scale are so important in agriculture. It's the number one thing that correlates with profitability in agriculture. So what we do, and just like buying kind of a really large apartment building or office building, you want to buy other buildings kind of right in that area so you can really leverage your management for that area. It's much more operationally efficient to do that rather than buying stuff kind of all over the country willy-nilly. So our strategy is very much leans into that. So we're buying at least $50 to $100 million worth of farmland in tight geographic areas where we have an on-site farm manager on that land. And our farm management team, we develop a 10-year crop rotation plan for that land. We develop an organic conversion plan for that land. We identify the ideal crop rotations. And once we have that ideal crop rotation, then we identify the best farmers for that land. So that's where we're bringing in kind of the best tomato farmer and corn farmer and green bean farmer and grain farmer and pasture manager as well. And we're rotating those farmers around according to healthy soil biology practices. That crop rotation strategy and that crop diversity strategy is what allows us to get that ground certified organic so easily. It's what allows us to have all those soil benefits along with cover cropping, et cetera. That crop diversity really is kind of the fundamental hallmark of our agricultural system, and it also delivers great benefits on the business side as well. So in addition to that crop diversity, we do look at the individual crops. And so this is talking about basically timing. This is an example of the almond market. So the almond market has been generally very successful for farmers, especially over the long haul. The demand for almonds from 1995 to 2025, it's grown from about 500,000 pounds to 2.7 million pounds today. So really significant supply and demand growth. But when they plant too many trees and they mature kind of 5 to 7 years later, sometimes the supply overtakes the market, and then the price goes down. And so that's that yellow line here. You see that kind of price volatility. Just recently, we had a significant amount of kind of overplanting. The price went down pretty substantially, was down basically around $3.50 a pound for a 3-year period. We saw this overhang basically go away. We saw trees that were planted without good water rights being torn out or poorly managed being torn out, and there's not a lot of new stock now coming online, and you see it's kind of hitting that trend line as well, that kind of up trend line. So we were able to buy a property out of bankruptcy. An institutional investor had over leveraged themselves and got stuck with higher interest rates when their debt expired, and just didn't have the cash at this 150 price per pound. So we bought that at 48 cents on the dollar last year. We sold the crop over the past year at an average of $2.43 a pound. So we are very happy with the purchase that we made in terms of long-term value, and also where in the cycle we bought it as well. This is part of the asset. Again, almonds are part of the assets of this fund. This property that we bought at 48 cents on the dollar is part of the fund, and investors who come into Fund 3 would be getting in basically at 6% above the price that we paid for it. I'll talk more about that a little later. Let's talk about Farmland LP. So these are some kind of additional items in addition to kind of the core farmland and crops. So Michael Burry was very successful in the last real estate cycle, bond cycle, and he really identified that water was a key factor to invest in. It was going to be one of the most constrained assets, and he determined that farmland was the best way to invest in water, and we agree with them. So and people really don't know about water as an asset class, and it's a critical part of the value of our fund. So things to know about water. Water is a property right. So under the Constitution, basically, in most of the states west of the Mississippi, just like private property land, the water rights that you have are also private property. The state can't take them away without just compensation. Farmland, when people came out from the East Coast and settled the West Coast, the first thing that they did was set up farms and farmland and started using the water. That gave them the right. So the farmers have the seniority on the water rights, senior to the cities that often came much later. And in the state of California, for example, it's after 1914 that anyone who has water rights pre-1914 is senior to the state of California in the water rights. When the state of California says they're shutting off water, they're shutting off water to everybody who has junior water rights to them after 1914 to preserve the water for the senior water right holders as well. It's pretty amazing the way that it works. Farmland is the best way of getting access to water. So when you're buying farmland, it really is a dual purpose investment, buying both the productive farmland, which you're getting cash flow from that water by converting that water into food, and you have those water rights for the long haul as well. So we can talk about the pricing of water as well, but let's keep going on. We are another thing that's great. For the past 16 years, we've been sequestering a lot of carbon, but not getting paid for it. And about 2 years ago, we were able to identify a great protocol that we can basically farm in a certain way, measure certain things, and actually document that we are sequestering carbon and sell that carbon as carbon credits going forward. And we are just in the process we've already gotten it approved by the verifier. The actual registry is looking at it. And then I think sometime in the next month, they should approve that. And that'll basically allow us to sell those carbon credits. And we're already in talks with very significant investors about actually buying those carbon credits. That should be that'll be in basically Q1. So that'll be accretive to the fund in a significant way. It could mean an extra $250 to $500 gross per acre, which is really quite significant.
That's amazing. This is just like a byproduct you get almost for free for just doing what you do.
It takes a little bit of work, but yeah, it's stuff that we would basically do anyway. Following the protocol, we have to do a lot of kind of sampling on that, but it ends up at basically a 50% margin for us, and it's significant revenue to the fund. And yeah, so we're taking almond orchards, for example, that normally are farmed like a moonscape. They're completely sprayed out at the bottom. It's very depressing for me to look at other almond orchards. And what we do is we turn it from a drip system to a sprinkler system, irrigate the aisles like you see here on there. That's actually a vineyard that we just planted. And then we manage that cover crop in the middle. And that, along with the plants that are growing on the sides of it, that cover crop is really sequestering a lot of carbon. We measure it against a baseline, a control sample that's farmed conventionally. And the difference between those two carbon levels, the way that we farm it and the way that the conventional farmers farm theirs, that's the amount of carbon credit that we have.
Okay, that's super cool.
So, and we're using like the highest rigorous standard, which is measure and remeasure, as opposed to just doing like a modeling approach. We can spend a lot of time on it. It's a separate call.
Okay.
Microsoft actually is an investor in Fund 3 as well. So you'll be shoulder to shoulder with Microsoft. Not only do they invest in the Farmland Fund, but they also are interested in acquiring the carbon credits that we're producing. So we're really thrilled to have them, gone through their due diligence and have them invested in the fund. They're a great reference for us. And they, along with a couple other investors, are on our LPAC, our Limited Partnership Advisory Committee.
Hey, sorry, before you get off that, folks have asked this question in the past. So some folks have had concerns that, oh, well, gosh, if Microsoft's getting involved, are they calling the shots? Are you getting bought out by big tech? What's your response to that?
They are wonderful and hands-off. We talked with them and negotiated with them for a long time, but actually, their primary interest is actually on the carbon credit side, and so they wanted to get access, kind of priority access, to the carbon credits. Basically, they can, if whatever people are willing to pay on the carbon credits, Microsoft could get them as well. They have a right of first refusal on the carbon credits. Can't set the price, but they just want to be able to buy the carbon credits, which is great for us. We have a built-in buyer. As far as control, they're just on a normal limited partnership advisory committee. They don't have control over the management company. They're just an investor in the fund. They're a proportional of the other investors. They have no higher vote than any other proportional investor. So they do not control anything. And they're actually been wonderful to work with. They've really done a lot of stuff for us as well. They took our company through a program that they have for their impact investments to basically help us turn into an AI first organization. It's an extraordinary program. It was so amazing, and it was really triggered a whole bunch of transformations in our organization. We were already doing a lot on technology with satellite imagery and aerial imagery and drip irrigation systems and all kinds of automation and tracking, et cetera. And this is really kind of reframing it as a bottoms-up AI-first organization, and there's going to be amazing stuff coming out from us on that. It's really a lot of fun. It's great to have their support. The resources that they've opened up have been extraordinary.
All right, great. So they're a deep pocket, they're an evangelist and a supporter for you, but they don't call the shots. They don't have control. And
Erica actually led the investment with us. She is the biggest fan of true regenerative agriculture. So it's not like Microsoft, it's not Bill Gates at all. It's actually off of the corporate balance sheet. And Erica really is an advocate for regenerative agriculture. It's just absolutely great to have her on the fund.
All right, great.
Great. How to invest? Good. We're wrapping up right here. So fund, these are summary terms for Fund 3. This fund structure is basically exactly the same as, almost exactly the same as Fund 2, and very similar to Fund 1 as well. And what we have is a fund that's set up with a corporate blocker. So some people are concerned about getting K1s each year. You can get a K1 if you're a larger investor, but if you just want it to be a normal investment and look like an investment in any other basically private company, you can invest in this corporate blocker. You'll get a 1099 div. You only get taxed when there's a cash distribution on that. So it's a very simple, because of our legal structure, it's a very simple way of investing in high quality farmland. The minimum investment is $100K. If you're going through an IRA and they're handling a lot of the paperwork, it can be as low as 50K as well. It's a 10-year term with 2 one-year optional extensions. It's already been a couple of years, so basically there's as much as 10 years left on the fund. There's a 1.75% management fee. There's a 6% preferred return on that. We have to deliver that accrued 6% per year preferred return plus 100% of your capital back before we participate in the profits that are generated, and that's a 20% carried interest on that. So. And we're basically targeting low teens on the return and 2.5 to 3x cash on cash return on that. We are closing the fund at the end of the year. Adam wanted us to come on and talk to you. We are able to kind of give you a whole data room. If you have additional questions, we can answer any additional questions that you have. But basically, you'd be investing in a fund where we already own, we've already deployed the capital that we've already raised. We have farmland that you can do diligence on it, and the additional capital, we have about $1 billion of additional farmland in our pipeline that I would love to acquire. So it'd be really fun to have people in the fund. You get to come out and do fun events like Blueberry Day and things like that.
All right, so we got a ton of questions that are going to be related to this page.
Actually, sorry, last slide, and then we can go back there.
Yeah, I was going to say, make sure you end where folks should go to learn more, and then I'll ask my questions.
Yeah. So in summary, why invest in Farmland LP? It's a consolidating sector. There's really demand for farmland, demand for organic food, demand for high quality organic blueberries and other crops like that that are greater than the supply. It's generated great long-term performance as an asset class with returns and with impact as well. So, and there we're harvesting green beans in that picture right there. And if you're interested, you can email us at IR team, investor relations team at farmlandlp.com or at farmlandlp.com/invest. So that's the prepared slides. I probably have some extra slides if you want, but let's answer some questions.
Yeah, why don't you keep them in reserve and pull them up if they're relevant to these questions. Okay, folks, I'm going to start going backwards through the questions that have been asked. And obviously, as you have new questions, just ask them here in the live chat. But let's, if you could, maybe just go back to the page of terms there for Fund 3. Craig, I think it was 3 slides ago. There we go. All right, first a question from me. On the term, you say 10 years and we're a few years into that, but there's some optional extensions. What is the current expectation of what will happen at the end of the term? Is it a liquidation of the properties, or would you want to continue managing them and you've got some provision for what would happen then?
Yeah, what I want is less important than what the investors want. And so the investors at the end of the term have the contractual right to get their capital back, like as a fund liquidation on there. And so that's kind of the first place, is that it's your capital and we're here to hopefully deliver great returns and great investment. And when you want your capital back, we need to make that available to you. Now, what we want, we're long-term fund managers. We've been doing this 16 years. I started this when I was 40. I want to do at least till I'm 70, but my grandparents died at like 92 and 94. Basically, one died carrying his lunch pail off to work at like 92. My other grandfather died at 94 sitting on a leather chair after coming back from work. So, you know, my grandfather used to joke that he only works 1 hour a day from 7 to 8. Of course, he meant 7 a.m. to 8 p.m. So we love farmland. We really spend a lot of time to find the best farmland. We spend 3 years converting it to organic. We spend more years planting these high value crops. They're just getting good, you know, in the second half of the fund, and they've got decades to run after that. So from that context, yes, we want to provide exits for investors, and they have a contractual right to get out then. We'll also make opportunities available for them to stay in. So whether it's a continuation vehicle for that particular fund, or what we do expect to do is to create a large organic cash flowing farmland REIT on there. So as assets, basically, if we're generating 10% net cash flow to the asset, and the market is happy with the 5% cash yield, we can roll it out of the private funds that we have into a larger long-term vehicle, an evergreen fund on there. So you as an investor would be able to stay in or exit at that point as well.
Okay, let me just make sure everybody understands that, because this is an important point. There's no guarantee for this. I just want to make sure, correct, right? But there is the potential, you're saying, to create a publicly traded REIT within which these farmland assets could be placed, and therefore, as an investor in this fund, your private shares would basically be converted into public shares in this REIT, and then you can hold or sell them at your pleasure. Is that accurate?
With a lot of nuance, yeah. But yes. So, like for example, if as some of the assets, like one of the farms, for example, becomes nice and strongly cash flow positive, that could be rolled into the evergreen fund, this cash flowing vehicle. And then for that portion of your investment, you could choose whether to liquidate at that time or stay there. Does that make sense?
Okay.
And also there's kind of a phasing to it as well. First, it's focusing on a private cash flowing vehicle, and then kind of moving to that public side as it reaches over $300 million in scale.
Okay. So let me just clarify a few things, then I'll get to some more of the questions here. So your plan is not to build an agricultural fund that then gets liquidated in 10 years. You are planning for decades, but in this fund structure here, at the end of the 10-year term, the investors who buy in now have the option of saying, "Hey, no, I want to get out. You know,
the right.
Pay me the fair market value of my investment."
They have the right to get out. Absolutely.
They've got the right to get out. Okay. And then potentially after that or along the way, there may be opportunities to put assets in this fund in a public REIT of the sort that you're talking about. Obviously, you would probably only do that if that was beneficial for the investors of this fund, meaning they would be getting some premium benefit to that. And of course, they would have the option as to whether they would want to participate in that or not.
It's our job to be such great managers of the farmland that from an asset appreciation standpoint and from a cash flow standpoint, that they want to continue even though the fund is technically ending. And so It's our job to give them an opportunity and a structure that they choose to stay in on, but they have the right to choose basically to stay in or get out on that.
Okay.
So that's what it keeps our feet to the fire, and it keeps us focused on being great investment managers while managing these fund assets.
Okay, great. I just want folks to know you're investing really for the long term. The 10 years is a contract where you're saying if you want out, well, you certainly can get out then. And of course, I think you're going to have potential liquidation windows along the way for people. Well, let me ask that question. Within those 10 years, let's say someone buys in now, 5 years later says, "Hey, you know what? I want to sell all or part of my investment in this fund." Will there be windows to do that?
From a legal standpoint, it's a 10-year fund. The investors should be prepared to go the distance on that. We have had situations where people come up from estate issues or things like that, where we have been able to basically kind of bring in other investors to help take out other investors. There is a demand for people want to invest in prior funds as well. Our first fund is been going for 16 years basically, and about 75% of the investors are still in that fund. So that was set up a little bit differently. They had a 6-year lockup and twice yearly redemption opportunities over a 30-year time horizon. But most of the investors are still in that fund.
Oh, okay. But so if you're investing in this, plan that you're investing for the 10 years. But if something comes up, no guarantee, but Farmland LP will work to match them with an outside investor who wants to buy into their shares. So there could be the potential to sell some of your stuff early at whatever the market value is then. Might be higher, might be lower.
Whatever. So all of the new investors have come in at the fair market value, which we basically every year get audited financials and third-party appraisals. The audited financials are done on a cost basis, so it's the original purchase price. And then we determine the current fair market value through appraisals and add those two together basically. And that's the fair market value of the fund, basically the farmland plus the assets minus the liabilities. And all the people who have exited have been exited by people coming in at that fair market value.
Okay, got it. All right, Steve here says, are earnings reported via a K1? Craig already answered that. Generally, no, unless you're a larger investor and want a K1. Otherwise, it's a 1099 div, right?
That's right. So there's a corporate blocker at the top where literally 99% of the people are invested in. And If you want some of the tax losses and you're a larger investor and you can handle getting a late K1, for Fund 1, we deliver the K1s by April 1st. But in Fund 2 and Fund 3, then they're not delivered by Fund 1. So we're going to talk to you about kind of the downsides of getting a K1, but for larger, sophisticated investors, they like that, and that is available.
Okay. Ludger here just wants a little more specificity on the mechanism for getting out after 10 years. So it's year 10, guy says this has been a great ride, but I want out. What exactly happens?
If 80% of the investors want to get out of the fund, then we sell the farmland and distribute the proceeds. If 20% of the investors want to get out, we might lever up a little bit. So generally we have under 30% leverage anyway. And as these funds generate cash flow and mature, that goes even lower. The asset value increases. So if it's a small amount, we can potentially lever up and get them out. If it's kind of in the middle, then we bring in other investors and just kind of arrange a nice exit. So
okay, and they would exit at that the most recent appraised value of the land, as you were talking about earlier.
That's what's happened historically, and that's what I expect to happen in the future. And then there's the kind of the market upside. The reason why I like the Evergreen Fund is that has the potential of valuing that farmland not at its asset value, right? Not at its appraised farmland asset value, but more at a credit value. So if we're generating 10% net cash flow to the assets, but the market is happy with a 5% cash yield, that would actually trade at double the value of farmland potentially. So that's especially if it's public. So that's the advantage of that kind of long-term evergreen fund for investors investing in the private funds versus kind of coming into the public markets.
Got it. Yep. Okay. You sort of answered this, but Mark asked, do you lever up these assets in order to boost returns? Sounds like your current leverage ratio is a little below 30%.
Yes, that's right. So we understand leverage. We understand its risks. Typically, what we're doing is we're buying the farmland for cash and then using debt for improvements on those properties. And that's generally under 30% on that. So.
Okay. So we're getting questions about let's say the annual economics, right? So there are distributions that are made. When do you expect those distributions to begin? Because they probably don't begin in the early years when you're going through the 3-year, building up to organic status. And so you've got basically a combination of distributions from cash flows and any potential appreciation from the appraised value of the property, right?
Right. So the kind of standard expectation that the investors should have is not to expect cash flow for the first 3 years or so. And so that's really while we're going through that value add phase. And then we expect the cash flows to increase significantly from what the cash flow was before we bought the properties on there. And one of the nice things about Fund 3 is that because of kind of some quirks in the market, some of the pressures on certain of the institutional players, we've been able to buy mature cash flowing permanent crops at great prices. And so some of those should actually really drive cash flow earlier than our normal time horizon. I'd still rather surprise to the upside. So investors should have that kind of longer term view on cash flow.
Okay. And with that 3-year acreage improvement to organic, also just to manage expectations, let's say it's for example, a 100-acre farm. You don't necessarily do all 100 acres in the first 3 years, right? You're kind of flighting it across the age of the property. Is that true?
Well, Adam, that's a lesson that we learned over the past 16 years. So where things were kind of spread out, especially when we added blueberries kind of partway through Fund 1 on there, which suppressed cash flows for a few years. So for Fund 3, really we're very focused. One of the reasons why we've raised capital and deployed that capital and already are doing the redevelopment on that farmland is because we want a very tight value add period. And so we are front loading the value add period for this farmland to the front end, basically kind of doing it all at once. But again, the nice thing about Fund 3 is that we've been able to buy properties where some of the value add that we'll be doing won't impact cash flow as much. So for organic vegetable ground, you're basically getting zero net cash flow. Well, that's not true anymore. Normally, when we convert farmland to organic, we get zero cash flow on that, net cash flow on that land, because we're doing the conversion ourselves. In Fund 3, this is the first time that this has happened for us, is that we have over 500 acres of farmland that was conventional, and we have 2 different farmers who are leasing that farmland for 6 years. 3 years as conventional, where they're paying us $350 an acre. They're converting it over to organic during those 3 years. And the second 3 years, we're getting $750 an acre for the organic farmland. So this is actually a really big milestone for us, where we're actually getting paid for that land to be converted to organic.
Wow. Yeah, that is a difference from the first 2 funds, a good difference. All right, I'm getting still a ton of questions here about the economics. I've got one guy here who's frustrated that we're not getting to the details fast enough. I promise folks we'll answer every question that we get asked here. Okay, so where is it? Somebody was asking about the IRR for the investment over the 10-year period. Do you guys have the internal rate of return calculated?
Yes, so basically we're targeting 12 to 13% net.
Okay. And when you say net, you mean net of management fees, right?
That's correct.
Okay. And then a sort of a similar question here from Chris is to say, hey, so the way I think about this is an effective annual return of about 4.25, meaning I'm getting that preferred accruing dividend, and then you've got it, I'm subtracting the management fee. Is that the right way to think about it? Or do you expect over time the appreciation and the cash flows to get to a point where the return will exceed that 6% dividend?
So the way to think about, well, the 6%, I think he's referring back to over the past 85 years, 11% annualized return, half from cash flow, half from appreciation on that. I think that might be kind of the...
Oh, okay. I thought he was talking about your first bullet point here at the bottom, the 6% annual preferred accruing dividend.
No, that's a 6% annual preferred accruing dividend. We have to pay that. Those are separate items. So the management fee really becomes just kind of a cost of the fund. The 6% accrues if it's not paid, but it does accrue. We have to return. So let's say after 10 years, if we haven't paid any of that 6% at all, we would owe 60% to the investors for that annual preferred return, plus 100% of their capital, so 160%, before we got paid our carried interest, that 20% carried interest.
Yeah, got it.
You don't think of that 6% as like a coupon on there. That's like a dividend coupon. The IRR, kind of the averaged annual return, is 12 to 13%. It's appreciation in the first few years, and then the cash flow really increases. It really ramps up after that.
Got it. That right. Okay. So for that average 12 to 13% IRR over the 10 years, folks, plan for some lean years at the beginning and some bigger years near the end. And of course, that's all because of the land conversion and everything.
I do consider this, and we try to manage it as a multi-generational asset. So we do want this to be a nice long-term asset, but we also recognize that people want, liquidity options and cash flow, and the cost for that really is just that first few years of value add conversion.
Okay. This fellow asks, is the accredited investor verification Is that done through a third-party verification process, or is it soft accreditation, which I think he means if I just tell you I'm accredited, will you believe me?
Yeah, it is third-party verification. We use what's called the 506C structure, which allows me to talk about our fund and what we do with people while we're fundraising, which is really only an option in the 506C process. What we have to do, that we're required to do then, is get that third-party validation. We can self-accredit for existing investors who kind of obviously comply. Like if they're investing $1 million, then it's really straightforward to self-accredit them. But in general, the first time everyone has to be third-party assessed.
Okay, I'm going to combine two questions. Robert here says, I'm looking for income in retirement. Historically, what has been the yearly distribution after 3 years? In your addressing that question, I want you to tackle this larger one here, which is, what are the actual realized returns to date for your earlier funds, Fund 1 and Fund 2? And not just promotional numbers, but basically, how have they done? And, Craig, give us the good, give us the bad. I as a Fund 1 investor, I know that there was some learnings going through that process. So fire away.
Yeah, great. Well, Fund 3 this past year was about a 7% IRR on there, which is nice. Fund 1 is Fund 2 is basically still in development on there. So that investment is actually overall down just a little bit, but still there's a lot of, that was development heavy. And so that farmland is basically still in that kind of development phase, just like an apartment building in development has that J curve associated with it. That's where Fund 2 is now. For Fund 1, the investors are up on that. The current numbers, I'd love for that to be, I don't know exactly what it is, but it's up somewhere around 50% or so right now. It's in an interesting phase. That fund, the IRR, went up quite a bit. And then we planted 600 acres of blueberries. So the IRR is 6.4% on there. And basically for Fund 1, we had a lot of great farmland appreciation. We converted the land to organic. We were getting good rents. And then when we started Fund 2, we added permanent crops to our organic row crop strategy. We identified 600 acres on this Burns farm as a great opportunity for blueberries. And we actually took 600 acres of land out of that rent program and planted blueberries. So we increased our expenses. And so the farmland values, the fund values, is basically flat for a number of years on there. And so over time, that kind of lowers the IRR. And we're just getting to where those organic blueberries are really starting to add value. So the number that I gave you was as of the end of 2024. We've had great growth over the past 3 years on the blueberries, now around $3,400 an acre. That's not yet reflected in the numbers yet. So we're basically at that launch velocity and J curve for Fund 1. So we expect that to really kind of be a cork that pops above the water quickly.
Okay, so I think I heard IRR of 6 something for Fund 1.
6.4 for Fund 1.
6.4 over 15, 16 years. How about Fund 2?
So Fund 2 is a little bit negative. We had investors come in at a couple different times, so it really depends on when you set the time, if you're looking at the fund overall or if it's by individual investor. But that is down a little bit. I don't have the numbers at my fingertip, but we absolutely have all that data available and full analysis for investors. Just reach out. We have it in our data room, and people at IR team at farmlandlp.com will get you all of those historical numbers.
Okay, so just ask the tough question. If it's a bit negative so far for 2, 6 something for 1, what's giving you confidence it's going to be 12 to 13% for Fund 3?
So we already own the assets, and we're very happy with the price that we paid for the assets. It's a great diversified portfolio, and it has a nice long-term trajectory. A key thing that's different between Fund 1 and Fund 2 is this rapid execution that we're talking about as well on Fund 3. So in Fund 1 and Fund 2, we really had a long fundraising period. When we started, we were telling investors 16 years ago, we buy conventional farmland and convert it to organic, regeneratively managed farmland. They didn't know what investing in farmland was. They didn't know if the organic market would be valuable. But the real believers and friends and all of that really came in. We've proven that business case over the past 16 years to where people are now paying us to convert our land to organic. We are much better now as well at buying, at executing, and our strategy is so that we're doing that value add stage very, very quickly and growing that cash flow quickly. The Fund 2 and Fund 1 will do very well. We're very comfortable with them doing well. The numbers I give you are based on appraised value and audited financials. The appraisals are very backwards looking, and when you're doing development on the land, the blueberries, for example, and the other permanent crops, as they're planted, as they're maturing, you get basically part of the cost that you've invested in there showing up on your balance sheet. But there's a lot of loss on there from a valuation standpoint. But as those crops get to maturity, as soon as they start producing positive profits, and when they get to mature production, their value increases from basically a partial cost basis to the market value of that permanent crop ground. And so we know that there's a lot of kind of built-in value, built-in upside in those assets that's really kind of just around the corner for Fund 1 and just a couple of years away on Fund 2 that will drive those returns higher. So okay. It is what it is. So yeah.
All right, great. No, I appreciate that. And look, it's my job to just ask the tough questions, and you're doing a great job of answering them. We want to make sure people have an eyes wide open expectation on this. The key thing to note about Fund 3 is, you've been in this business for a long time now, and you get those learnings and that expertise accrues. I've had a couple questions here.
One quick thing that I wanted to add is that because interest rates have gone up, we do have an option for people to come in if they want basically a coupon on this. They want kind of current cash flow, in essence, to replace some of that debt. So if people are interested in current cash flow, do email us and we'll give you that information and say that you're interested in current cash flow.
Huh. Okay. Is that like a different security or just a different way to get paid off of this?
So it's basically preferred equity. We're basically doing a cash coupon on it and replacing debt. You don't have the upside that you have on the equity, but it basically is a way of replacing debt for us.
Okay, but you get the cash flow.
I'd personally rather pay a real investor human being than pay a bank interest. Mm-hmm. So that's a little bit of a personal preference there.
Okay, so yeah, so all right, folks, if in addition or instead of the equity here, you're interested in that preferred equity, give contact these contact names here, farmlandlp.com/investor, IR team at farmlandlp, and they can give you more data on that. All right, Craig, we've had several Canadians raise their hand and say, hey, I'm kind of interested. Or can Canadians invest?
we love Canadians. We have investors from various places around the world. So yes, Canadians can invest.
Okay. And by the way, folks have been asking questions too about your farming practices. I'm going to get to those. I just want to hit the financial ones first before we get there. Okay. So he asks if it's an all cash fund or if you use leverage. You've already said you use leverage. Will it incur, and I'm not entirely sure what these are, UBIT in UDFI?
Unrelated business income tax. And yeah, so this is a taxation question. It's a very smart, sophisticated question. So the reason why we have one of the benefits of having that corporate blocker is that you do not incur UBIT. So if you're investing from, for example, a 401k or an IRA, if you invest in a leveraged asset, then you have to actually pay tax on that amount, even though it's in a tax-exempt account. And by having that corporate blocker at the top, it's technically an UPREIT structure. We just haven't checked the box to become a REIT. That means that the investors aren't exposed to that debt on there. You will just get a 1099 div only in the years that we do cash distributions, and that's the source of any kind of annual taxes. If you are a large investor and you choose to invest in the operating partnership and get a K1, then you could be exposed to that. But at that point, that's one of the reasons for the size requirement.
Okay. Someone asked earlier on, what is that size requirement, ballpark?
So generally it's $5 million. If you're at a million or more, then you just have to consider if it's worth kind of the extra cost and time on that. So it's more of kind of covering both their and our administrative costs.
Okay. You've already kind of answered this, but Don is asking about investing through retirement funds like SEP IRAs. Totally possible.
Ongoing. So maybe 10 or more % of our assets are from retirement accounts, like Alto IRA is someone who works. We have a whole bunch of the third-party fund administrators.
Okay.
The custodians, third-party IRA custodians.
Yeah. Okay. So Babette here is coming back here to the return on investment. I think you've already kind of given the general IR. Are dividends paid yearly or at the end of 10 years? I believe they're paid in the years where you have enough cash flows to make the distribution, but clarify.
Basically, they could be paid quarterly as available. So as soon as we get distributable cash, we'll distribute it. We're not holding on to it for any kind of future event.
Okay, but again,
in general, the investors should consider it basically annually, but as soon as it's available, it'll be distributed.
Okay, but as an investor, they should be mentally prepared that, hey, if I'm investing here early on, they're probably not going to be any for a couple of years, and then they might be sporadic for a while before they're happening like clockwork.
That's right.
Okay. Okay.
We want to maximize IRR as well as distributed cash. So.
Okay. And folks, hopefully you appreciate we're going through all your questions here, so I don't want anyone to leave feeling like we didn't take you seriously. Bert asks, what are the major risks both to capital and cash flow expectations? So when you stay awake at night on what could go wrong, Craig, what are the things at the top of your list?
Great. Well, I do think about risks to capital and cash flow. Actually, before I started this 16 years ago, it was partially being so concerned about what the Fed. I started in 2009. So if you remember what happened before 2009, I was doing private equity focused on capital intensive assets, and we saw the credit markets blow up. We saw asset prices get crushed in basically across the globe on this. We saw the stock market down, and I basically wanted to have nothing to do with the risk of the Fed basically continually printing money on this. And I had other concerns about climate change and various things like that. So started this in 2009 because of how all these things came together, and we thought this was a much better way of managing farmland. So farmland is very resilient. If it rains too much, farmland's used to that over the past million years or so. If it doesn't rain enough, we want to make sure we have great water rights and physical access to the water as well. Certainly there are things that can happen kind of on an annual basis. One of the nice things about that is that the government provides crop insurance. The government has a mandate really to make sure that its citizens are fed without fail. Like, can't miss a meal on this. And so the government has put in place a crop insurance program that makes sure that if there are crop losses, that the farmers get paid and can stay in business on that. Rent is a covered cost in crop insurance. If there's bad events for our blueberries, that's covered. We get coverage about 80% of our historic blueberry yields on there. So if it goes below that, then we get crop insurance on that. Again, I don't have that in apartment buildings. If my tenants can't pay their rent, then I can't go to the government and get a rent insurance payment on that.
Yeah.
There are risks. There's risk to over leverage. There's really kind of exogenous risks, but really I look at farmland as one of the lowest risk investments and certainly the least correlated asset to other forms of risk which you have in maybe a stock market that might be overly consolidated or overly high in there, or credit market or currency that's been printing on high.
Okay, well, let me follow that up with a question. I'm trying to find it. I can't find it here, but I'll just say it. They're saying, well, what would you expect to happen if the country went into a pronounced recession? And there were some other questions around that, like, well, would that decrease the demand for organic food? If we went into recession, would you expect to see a material hit to your business, or is there so much demand for organic product it wouldn't really matter all that much?
It's great. So one of the nice things about organic food is that it's really primarily grown in America. Like the organic food is for the U.S. is grown in America and sold in America. About 1% of organic food is exported, and about 7% of the organic food of high value fruits and vegetables is imported. So the tariffs, for example, that happen are actually make our market just a little bit bigger for the domestically produced organic.
They're helping you right now?
They're helping us. Yeah. If you're growing commodity corn and soy, you're getting crushed because China's not buying your product and other things. But there's a lot of other markets that are not impacted by the tariffs. So if there's a large recession in the U.S., one of the challenges with our current economy is kind of the big disparity between the wealthy and kind of the rich and the poor, the wealth inequality. And the fact is that the wealthier side of things is basically doesn't care about food prices. About 11% of the U.S. food budget is spent on food, and the demand for organic in that kind of wealthier segment is just really strong and durable. Not saying that it couldn't go down, but it's been surprisingly resilient. It's surprised me how resilient it's been over the past 16 years when we've had ups and downs.
Yeah. Let me tell you my interpretation. You can tell me if it's incorrect, but like, I feel like once a family changes their diet to go organic, it is a decision they do not lightly reverse. They will cut corners elsewhere in their spending. They'll cancel subscriptions. They'll do whatever before they say, you know what, I'm going to feed my children less healthy food. And then to the point you're saying, Craig, folks, sorry, this is what I talk about on the channel all the time. The top 20%, 10, 20%, they're still doing just fine, and they're happy to eat as much organic as they can. And it's going to take a lot before they start crimping any of their demand, their purchasing for healthy food.
I started Farmland LP shortly after my daughter was born, and there were some very, very lean years when I was starting this and building the company, and never did I think, oh, you know what, I'll just let her eat pesticides this year. Mm-hmm. So that's like it really does become so. The largest source of new organic consumers is new moms. Before they get pregnant, they start to shift their eating habits, getting their body kind of ready, and organic is one of the key things that we see a shift in their behavior patterns. When they're pregnant, they're eating much better, and then that question is, you're feeding your baby from your body, and then what's the first food that you feed them from, like when they do that? Well, it's milk, and invariably it's organic milk that moms buy for their kids on there. And then it's organic baby food. The largest demand for organic baby food is from China middle class. 300 million Chinese middle class do not trust the food in their own country. And there's tremendous demand for organic baby food from outside of the country on that, from the middle class and for their kids. Anyway, there's like, yes, you're absolutely right, Adam. There's strong durable demand and there's strong growth in the sector from new moms. And then once you convert over, people really don't go back.
Okay. All right. I've got two last quick questions around the money side, and then we're going to get to the sustainable farming side. Jonathan asks, is being an accredited investor a prerequisite for all investors under $1 million? I think the answer is that yes, but Greg, tell me.
It's a requirement of the 506C. What allows me to talk about this is a requirement for 100% of the investors to be accredited investors.
Okay. All right. And then Dawn asks, is crop insurance still going to be available in the future? Look at what's happening right now. I'll give my 2 cents. I'll let you respond, Greg. But like, I feel like, yeah, crop insurance is going to be one of the absolute last things that the government would ever stop, because most governments, their greatest fear is the piper that's rising up against them. And the fastest way to do that is to cut off people's access to food.
Just a couple weeks ago, as much as the government is trying to cut people, the government brought back a whole bunch of USDA staffers to distribute financial aid to farmers who were impacted by the tariffs, by the tariffs that were impacting corn and soy. So yes, the government is not only going to keep distributing cash, but they're actually bringing back people and hiring more people in order to make that machine run.
Okay. All right here. Okay. Chris says, in the US, much, quote, sewage sludge is spread on farmland. Yeah. And is often loaded with many toxins, including heavy metals and PFAS, forever chemicals. This process is illegal on organic farmland, but the 3-year waiting period does not in any way mitigate contamination with heavy metals and forever chemicals. Is the soil on the land, I guess on Farmland LP's land, being tested for contamination before being purchased?
Yes, it is. And Chris, that's a very smart question. Let's go have a glass of wine. So my degree is in biochemistry and molecular biology. We have a very science-based approach to this. Spreading sewage sludge on farmland is horrible for a number of reasons. In 2009, when we started, we tested the land for heavy metals. And that's one of the things that actually comes along with sewage sludge, is a high concentration of heavy metals. And there was basically not really any other tests that you could use to determine if sewage sludge had been put on land. So we tested for heavy metals, and then we looked at the fingerprint of what the heavy metals look like compared to the other baseline minerals. And if there are high heavy metals, i.e. sewage sludge, we would not buy that farmland. So we continue to test. And on this last apple orchard that we just bought, we actually tested for PFAS on it, and that came back negative. So we do a lot of work actually to make sure that we're not buying farmland that has sewage sludge on it. We've done it since the beginning. My standard, we convert farmland to organic. We do other things. There's a lot of programs that we do, but my real standard is, would I feed my daughter the food grown on this land on there? And I think one of the negative, the organic standard is wonderful. It's federal law. There's a lot of regulations in it. That's a great, great standard. One of the weaknesses is this 3 years then clean standard, where you can take land that was contaminated and still get it certified. But it's still a good standard. We do have a higher standard than that, though.
Okay. Where is it here?
While you're looking, Ian sent over a stat. Basically, during the 2008 and 2009 Great Recession, U.S. farmland increased 2%, while the S&P 500 fell 37%. So that's just a very clear kind of recent example of how farmland is a very resilient asset class compared to the other categories.
Right, resilient and also not correlated, right? Yeah. All right. Sorry, I'm having to scroll through everything here, folks, so bear with me. But basically, haven't found it yet, but the question had to do with biochar, which is, do you use biochar as a soil additive there at all?
So we don't currently use biochar. Biochar is most successful in the equatorial region, tropical region, basically, where it's a very kind of warm environment. There's a lot of soil biology that happens that actually breaks down the organic matter very quickly. We're more in the temperate region, so Northern California, Oregon, Washington, and there you actually have a lot more long-term resilience of the soil carbon that's in the ground. If you put the soil carbon in the ground, it's going to stay there for a long time. You don't need to basically put charcoal in the land. Now, we are looking at biochar programs and a couple other things to increase the carbon sequestered on our farmland for the carbon credits. I don't necessarily have a lot of kind of hope that it's going to be a great additional advantage from a soil biology standpoint or other aspects that people sometimes ascribe to biochar. But it would, there's good potential for it to profitably increase our soil carbon credits.
Okay, yeah, well, that makes sense. It's all carbon. All right, would you briefly mention what biological practices are used to improve the soil conditions once you purchase the land?
Cover crops are one of the most amazing things that you can do for the farmland. Crop rotations, if you're doing monocropping, you are really messing up the soil biology on there. All the pests that want to attack corn or tomatoes, for example, you plant it 1 year, there's some pests around, and then they multiply 1,000-fold. If you plant that same crop in there the next year, that 1,000-fold increase is going to increase another 1,000-fold. You plant it a third year, another 1,000-fold, and all of a sudden your crop's not going to come out of the ground. You're going to have your roots get eaten, or the other things get eaten on that land. If, however, you go from tomatoes to corn, totally different pests, to grains, to grasses, to livestock, and then back to tomatoes, Well, those pests that are crop specific have had no opportunity to explode on there. So that crop diversification is very helpful from a pest standpoint and agricultural standpoint. It also increases the above ground biology, the diversity. So pollinators and beneficial insects and just everything from earthworms to birds.
Yeah. Talk about the, I'm going to murder this word, the mycelium, the mycelial networks in the soil.
Yeah. Yeah. Now you're sweet talking me.
Yeah, I know.
So basically soil fungus is called mycorrhiza. And basically, if you think about land, so basically when all the life was basically fish in the ocean and nothing grew on land, the first thing to colonize land was basically lichen and fungus on there. And that started breaking down the rock and turning it into essentially soil. And then plants came after that. And they came into an environment where this soil fungus had already basically created this wonderful environment, and they created symbiotic relationships. And they're totally underappreciated, and they're totally essential even today. Blueberries are where we really focus on this from a crop standpoint. If you look at a blueberry root, it looks like a twig almost on there. It's not very efficient, and it needs acidic soil. Why does it need acidic soil? Well, to break down the bacteria and nutrients around it so that it becomes a liquid, so it just kind of can flow in to that blueberry root, right? So the blueberry root doesn't have to do much, just lives in acidic soil. Well, it co-evolved with an ericoid mycorrhiza, the soil fungus. And we actually put that in the soil to make sure that it's always available for the plant. And blueberry roots grow at the top 18 inches, but the mycorrhiza go down 12 feet or more and wide out. And the mycorrhiza literally grow into the root cells in there in a symbiotic relationship. About half of the sugars from plants are given to the mycorrhiza. And the mycorrhiza forage for water, fertilizers, minerals, and give those back to the blueberry plants in exchange for the sugars. So it's this wonderful symbiotic co-evolved relationship. And they've actually recently proven that there's signaling. When the blueberry plant is growing its blueberries and it needs more calcium for strong cell walls, it signals to the mycorrhiza. And the mycorrhiza, within a few minutes or less, will mobilize calcium and send it up to the plant. It's really miraculous. It's very cool. And we basically, our farming practices for the blueberries are basically designed to farm the mycorrhiza and so that they can take care of the blueberry plants for us.
All right.
So anyway, sorry, that was a very long story.
No, it's super cool, but a great example of biological practice. I just want to underscore, from our previous conversations, Craig, you always say, look, think of conventional farmland like chemistry, right? What do I need to put in the soil to grow something? Well, I got to go get some potassium. I got to get some nitrogen, whatever, because I just have this bare dirt, right? What sustainable/organic farming is all about is biology. Right, is how do I create this rich, vibrant soup of life, right? That's all symbiotic and helping each other out. So it's almost like thinking of your soil as like an aquarium, right? It's like, how do I keep all these forms of life alive and working together?
It's the life wants to be there. Actually, it's the chemical farmers who want to kill everything off.
Exactly.
All of this stuff, they're trying to prevent nature from getting into their little chemistry set here. And we're like, no. Let's actually have the natural environment help us grow more healthy, vigorous plants. What we do is we make sure that the we look at the soils, we look at the water, we look at the growing climate, we look at the slope, et cetera, and we say, what plants are going to be the happiest in this area? And then we make sure that the right plants go there as part of the crop rotation. And we do it at a large enough scale so that professional farmers can farm those areas and those crops. And when it's needed, we manage that crop rotation. So we're really fundamentally working with nature. That's why our fund management, our farm management, looks just a little bit different than other people. We're not doing that sale leaseback. We have to do this large scale agriculture, $50 to $100 million worth of farmland in one tight area. And we have 3 of those so that we can manage this farmland at a landscape basis, make sure that the biological systems all work together, and be large enough so that a farmer can come in and lease 1,000 acres of land and get that full economy of scale by specialization. And we manage the diversification through rotation.
Okay, folks, I'm going to try to wrap this up in 15 minutes, though I do want to make sure that you feel like we got all your questions here. So Craig,
the people who are still here are extraordinary. So this is great.
Well, they're fellow, kind of, I don't know, geeks, wonks, nature lovers, whatever we want to call them, like us. Okay, so I couldn't find it. I know there's a question up there saying, okay, so what are the risks of losing access to water, right? So you talked about having the most senior water rights, great, but they're not of any help if the water's not around, right? So like, we've had some big droughts in California, right? Talk about the dependability of water at the locations that you've chosen so far.
Great. So we screen, first off, we screen for all this ahead of time. When I was 20 years old, I took a class on oceanography and atmospheric chemistry. And we studied, at that point when I was 20, 30 years worth of history of the CO2 levels increasing that Al Gore later used. And then they were concerned about ocean acidification on there. But you could see this 30-year trend, hey, this is gonna keep going. This is gonna cause problems in the atmosphere, and you could predict some kind of global warming in the future. And I've kind of watched it as a scientist over that period of time. I'm 56 today, and sure enough, CO2 has continued to increase and accelerate, and we've seen real-world effects of the growing conditions changing. And Florida oranges are just kind of a great example of that. I won't go into right now, but a fundamental thing when you look at climate change and what might happen in the future and now is that there are certain parts of the world and the U.S. That are going to be hotter and drier, and certain parts that are going to get wetter on there. And so we made a fundamental strategic decision right from the beginning: only buy farmland in areas that are going to either somewhat stay the same climatologically or potentially get better from an agricultural and from a water standpoint. So we don't invest in certain parts of the U.S. We are investing in Northern California, Oregon, Washington. We can talk about why we're doing that. Each of those 3 geographies have a different water profile. So California has very strong laws that protect farmland owners with senior water rights, and they have a lot of infrastructure that's been built, a lot of dams and reservoirs by the state and the federal governments that were built with the contractual understanding that first they were storing the senior water rights holders' water. It's our water rights, but anything extra they would get to use. That's why they built all those water systems there. So we've never had an issue with not having enough water, even when. Go ahead.
Yeah, and just to let folks know, like the Burns Farm in California, that pulls its water. The source of the water that comes to the farm is directly from the Sierra runoff, right? So like as long as there is snow in the Sierras.
And the dams that support it.
And the dams that support it. But basically, as long as it snows in the Sierras, water will flow to that property.
Or rains, or they have water storage basically to get over the lean years. But if there's not enough water for agriculture, the cities before then have much larger problems.
Right. Right.
So
and let me just mention one thing, that the conversation we had, correct me if it's wrong, but this was a couple years ago, back during the California droughts, and the state was, sort of asking farmers, or I think you said the farmers got together, or the folks who had water rights got together, and they said, hey, let's share a little bit of this, because we don't want the state to get ideas to come maybe break the law or whatever. But essentially, if the state came to you and said, look, we're in a drought year, and I want to take some of your water, they would have to do so at a market price that you would almost be like, fine, like, I'm going to make so much money off of this, it's fine. Is that true?
Yes, there's two components to that. One is the long-term ownership of the water right, and the other one is what happens on a year-to-year basis. So our water is literally free. The cost that we pay for drawing the water from the river is just the cost to pump it around the farm, which is around $35 an acre, around $12 per acre foot worth of water. Okay. Other farmers who don't have those kinds of riparian rights, they'll pay around $250 per acre foot.
Wow.
For that water. Cities, though, pay generally $1,000 to $1,500 per acre foot worth of water. Okay, and that's what you probably pay when the average household uses half an acre foot worth of water in their home for a family of four. So if you're paying $600 a year for water, that's $1,200 an acre foot. So if the cities and farmers have a lot more water than the cities do, if the cities ever need water, then the landowners, the water right holders, right now they can't sell their farmland, but there have been kind of water banks in the past in special situations where people were paid to move their water. What happened in Australia, which is a real water stressed environment, 25 years ago or so, they used to have regulations like they have in California in the United States, and they switched over to a true water market, and where people would get paid for their water right. That's a great system. I expect something like that to happen in the future. The key thing is that people want running water from their houses, and they want food in their refrigerator. Mm-hmm. So it really is not like one versus the other. It's like, how do we have both? And what you don't want to do is grow corn for ethanol or things like that. So anyway, it'll help the market get more rationalized. I do think we can have it all, but I do think it'll result in cash value for that for those water rights.
Right, but if we ended up getting into that world, the people who would be best situated would be those who have the most senior water rights to plentiful water, right? Which is, again, I joke with you all the time. I almost think you should rename this Water Rights LP versus Farmland LP, because there's such potential optionality value in the water rights.
Yeah, but it takes 2 hours into the conversation before we can really kind of get into it. So,
well, thank the 74 people who are still here getting to the stage with us. Last point on this too, just to mention, again, if I remember correctly, the U.S. has, of its major aquifers, I think all of them are depleting, except for the one up in the Northwest, which is where your Walla Walla property is situated, correct?
Yeah, that's right. Yeah, so
that's the only one that's growing. It's not even just stable; it's growing, correct?
Yeah. So the Agua Walla aquifer under the Midwest, Nebraska, and down to Texas, that's depleting. Texas is having droughts because Nebraska is pulling too much water out and irrigating their crops. Over here, California, we're very well situated. We're mostly buying farmland in Oregon and Washington, though, as well. Oregon has wonderful rainfall patterns. And so it's in the mountains, they get about 111 inches a year, and it's about 46 inches a year in the Willamette Valley. Very stable under all the climate models as well. So we expect that to stay the same. And then in Washington State, it pulls water from Canada, which is why we love Canadians, one of the reasons. But it pulls water from a very large basin. The Columbia River has about 10% of the surface area as the Mississippi basin, basically from the Rockies to the Appalachians. About 10% the size of that whole Midwestern area, but half of the water flow of the Mississippi River.
Wow.
So there's an extraordinary amount of water that flows through the Columbia River, and there's an extraordinary amount of water that flows underground. So a lot of the water actually percolates down into the ground and then flows in these like vast underground rivers. And that's where we actually get a lot of our water from, not pulling from the Columbia River, but actually pulling from these like vast, huge amounts of water flow that are basically flowing through underground. And those are very geologically stable over time and managed at 100-year sustainability platform. Basically, they're regulating any of the water use. You have to prove that you're not going to impact the water flow over a 100-year period. So
interesting. Okay.
It's very well managed in other states, but water rights west of the Mississippi are state by state.
Yeah. Okay, we're in trouble if these are our short answers to the questions. Another question that's been asked is, hey, do you buy in properties outside the U.S.? Right now, the answer is no, right?
Yeah, we look occasionally, but no for now.
Okay. And then how about
under these funds?
How about east of the Rockies? Are you looking at anything actively, or are you still pretty much going to be a west of the Rockies fund for the foreseeable future?
Yeah, when we have significantly larger funds, then we'll add a fourth geography. But again, it'll be that kind of $50 to $100 million size minimum, and that will be most likely on the other side of the Rockies.
Okay.
To the East Coast, yeah.
All right. Dawn asks, what are your target crops in Oregon and Washington? The grape farmers here are struggling, as are some of the apple farmers.
So we were able to recently support and partner with one of the top apple farmers around. So help them kind of diversify their land ownership and invest into their very successful apple, cherry, pear business. So we bought land with Stemelt farmers, and they're just a wonderful organization. So that created an opportunity for us. We felt like we looked at all of the apple orchards around, and we felt like we bought very high quality apple ground, planted in very high quality apples and managed very, very well. So it creates good opportunities for us. The grape farmers are struggling, and we think that's a couple of years away from kind of turning around. The lower quality vineyards are being pulled out. The poorly managed ones, the ones that are too small to really generate good economics. So it's steering towards kind of the larger, higher quality farmers, which we are good farm managers. So there's kind of different targets, but really there's 300 different crops that grow on the West Coast. So we have a lot of diversity. We want diversity in the fund, and some of them, it just depends on kind of the market cycles. We have a 10-year view when we're buying farmland and kind of building our diversified portfolios. Look, it's one of the reasons why we're fans of fund structures. We certainly could have sold individual farms to investors. We could have had that model, but we really stuck with our fund model because we think that diversification is so important for farmland investors, and we want to kind of give that to them up front. So we do like diversification within these portfolios. It works very well.
Okay, great. How often do you test your soils to ensure all the healthiest microbes are plentiful?
If there were better tests for healthy soil microbes, we would do it. But there are more microbes in an ounce of soil than there are cells in your body. And it's incredibly diverse. And what we do is we make sure that we have a very healthy environment for microbes in the soil, make sure that they're treated very well and that they have basically everything they need to basically have good symbiotic relationships with the plants. But there unfortunately aren't good tests to actually determine what's good on that. Same with some of the bio plant companies that are creating basically, hey, here's a microbe that you can buy from us for a lot of money and spread it on your soil and it'll be great. Okay, well,
like a soil probiotic.
yeah, exactly. They're basically probiotics. And the concern is, well, they're going to be competing against trillions of other bacteria there. So hopefully you have like an Arnold Schwarzenegger. Anyway, it's much better to create a healthy environment for the bacteria. And unfortunately, there's not a lot of great tests.
Okay. You said, what's the minimum, or this question is asking, what's the minimum to invest in the fund? I think I remember from your page, it's $100,000 unless you're doing it in an IRA, and then you can do 50.
From an RIA, from a registered investment advisor.
Oh, sorry, not an IRA, but yes, if you're investing through your IRA, your financial advisor.
Through your financial advisor, exactly. It's 50K, that's right.
Okay. All right, so I guess if you want to put 50K, only 50K in, call your financial advisor and say, hey, contact the guys at Farmland LP and work with them. We've talked about this many times in the past, but I will ask it. What advantage do your funds have to other options, like the fractional ownership models used by, say, Farm Together? Or what was the other one? Acre Trader, I think was the other one.
Acre Trader's another one. So, our costs tend to be about half of theirs. So you get economies of scale with ours. You get active farmland management with ours rather than just kind of a sale leaseback or a financing relationship there. You get instant portfolio diversification with ours rather than kind of buying one farm at a time. They're different models. I think we could do what they do. I think there's real advantages to buying larger properties and having a single on-site farm manager of an aggregation of multiple properties of 50 to 100 million at a time. Like that, to me, $50 million to me is like the minimum economy of scale for having a hub there. And that supports one on-site farm manager on there. If you're buying a $10 million farm, how are you going to manage it? I don't have a way of doing that. That's why we stick to our strategy, and that's why now we're at 100 million minimum per scale, and we're continuing to expand onto that, continuing to leverage in the economies of scale. So it's a different model. If you want to kind of build your own portfolio one at a time, that's fine. It's hard work finding great farmland.
So the way I think about it, and correct me if I'm wrong, first off, you guys do the organic, sustainability model, and many of the farms on Farm Together and Acre Trader do not. Secondly, yours is like a professionally managed mutual fund, right? Where you've got diversification, you're building the optimal mix of whatever you think is going to deliver the best returns for the investor. Where these other ones are like individual companies, right? Oh, I'm going to buy into a pecan farm in Georgia, or I'm going to, have a fractional ownership in this sorghum farm in Oklahoma, right? So you don't have the diversification that you get there, and you don't get the economies of scale that you were talking about, especially when it comes into investing in capital investments and infrastructure that can be leveraged for years or decades. Did I get it?
Yeah, if there's a pecan farm or something else right down the street and it's being offered fractional ownership on one of the platforms, great, go for it. If it's a pure financial investment, I want large scale economies of scale, growing diversification, active management, organic conversion. We grow crops on a third of the acres ourselves, so we're getting kind of the direct economics diversified with the rent. And any farming we do it at cost. We have a 55-person farm management team. So you're getting kind of that also that kind of diversified exposure from rents versus direct cash flow as well.
All right, got it. All right, I promise I'll keep this rapid fire now, folks. So let's set a timer of 5 minutes, and we'll let these folks get on with their lives. Greg, somebody did ask the question: what happens, like, if a tenant farmer pulls out? Right? How impactful is that to the farm if you get surprised that way?
There's basically zero vacancy in farmland. So there are farmers who want to farm crops. Farmers typically have excess capacity. If a farmer goes bankrupt, or farmers are also there for multiple generations. So if they don't pay rent one year, they'll never get an opportunity to rent another acre of land again. We had a situation where a farmer really lost his shirt on a crop. CBD, basically. They were growing CBD hemp up in Oregon on there, and we made sure it was legal for them to do it and all that stuff. But they absolutely lost their shirt on it, and we felt bad for them. 2.5 years later, 3 years later, they came back and wrote us a check for the rent. We charged half the rent up front. We got $500 up front for that, so more than we would have rented the land for otherwise. They came back and paid us another $500 after a few years. So
well, so farmers are good people. That's what you're saying. They're honest. They'll do what they can. But
to be good to their word. That's right.
But to your point, a guy just calls you up in the morning and says, "Craig, I'm sorry. I know we've got this contract, but I'm just getting out of farming." You've got a whole list of, it sounds like, aspiring tenants who would happily come and take his place the next day.
Yeah, but and it's also sometimes we have to pursue stuff as well and make sure that stuff happens. This is commercial real estate. We're used to that, but it's not a usual occurrence.
Okay. All right. Just quickly for Canadians, is there any? Can they invest without any cross-border complications or tax complications?
I do not know that.
Okay, so talk to your accountant.
That's for their tax advisor, yeah.
Okay. And then beyond Canadians who you love, if somebody's watching from another country, can you take investors from anywhere, or do you have limitations?
If they can pass a KYC, then it's fine.
Okay, that means know your customer test.
AML, sorry, the money laundering.
Oh, anti-money laundering? Okay.
Yeah, anti-money laundering, yeah. Right. So if you're a terrorist, no.
All right.
And we generally like the smarter people and the people who have good souls, and they're generally better looking as well. Like, they all seem to be like my investors. It's a Lake Wobegon kind of.
They're all above average. Nice. All the women are beautiful or strong. Can't remember which. Donald asks, how do Oregon or Washington treat senior water rights? Is it the same as California or different? And if different, how so?
Okay, that's another hour call. But basically, the years are like in California, it's 1914. In Oregon and Washington, there's different dates on there, and there's different. Everything's kind of different by watershed and the water source. Is it a dam? Is it a natural river, et cetera? And they're regulated in different ways. So we have expertise in water rights and buying water rights. We also have consultants and attorneys who are specific for water rights in each of those areas. And so it's a point of differentiation for our fund. But the general rules are similar. It's a private property right, but the scale of that right, like the seniority or the priority of that right, that's what's kind of different on basically a per parcel basis. They have to know what you're getting.
Okay, and then last question, which I believe you've already answered. Is there an opportunity to stay in the fund past liquidity events? And so the way I interpreted what you've said, Craig, is, hey, the fund intends, no guarantee, but the fund intends to manage the property far beyond the 10-year expiry of the fund. And if investors want to continue doing that along with the fund, they will be welcome to.
Yeah, we love what we're doing. We're going to continue. We want to continue to manage farmland, to grow our farmland under management, and to create more and better vehicles for investors to invest in. People have different profiles, whether it's cash flow or asset appreciation and different time frames, et cetera. As we get larger, we'll be able to do more of those things, and that'll increase in general the liquidity options for investors, but also increase the options for investors to stay in the funds or stay in farmland much longer term. We would like to, continue to manage this ongoingly.
All right. Well, Craig, look, I think people really appreciate the mission behind Farmland LP, and I think they can, they probably suspect it takes a certain quality of person to create and be involved in something like this that's trying to deliver returns for investors, but also try to make the world literally a better place. And I think they probably know by now that you've just given over 2 hours of yourself to present, but also address every question that's been asked to you, the type of manager that you are in terms of how you'll treat your investors. So anyways, a big thanks from this audience and me of giving so much of yourself here today. Why don't you just remind folks, if they're interested after having watched all this in learning more about how to invest, again, where should they go?
Great. So you can email irteam@farmlandlp.com, so investor relations team at farmlandlp.com, or go to farmlandlp.com/invest. And you can fill out a little form. We have all kinds of information that you might want, certainly information on the funds and due diligence information, information on prior funds, as well as performance on that, and any questions that you have, we're glad to answer them for you.
All right, great. And Craig, folks were asking if they could get copies of the slides from this presentation. Are you okay if I send them to folks along with a replay video of this?
Of course. And they can also, we're glad to send them as well, but yes.
Okay, great. So folks, you'll get these slides from multiple sources. All right, well, look, in wrapping up, folks, let me just give a caveat here. Again, I'm just the MC of this. Nothing I've said has been any sort of financial advice. I'm just here to represent you and ask the questions that you want asked of the guys here. So, do your own due diligence or talk to your own financial advisor about whether this is an appropriate investment for you. But I can tell you that the team at Farmland LP will stand ready to answer any and all questions that you or your financial gurus may want to know about this. If you can, folks, please just give Craig and the team from Farmland LP your feedback and props here in the live chat. And if you appreciate seeing presentations like this, webinars like this, on particular investment opportunities in themes that are of interest to the Thoughtful Money audience, let me know in your feedback here. And if so, we'll do more of these as relevant going forward. Craig, it's been great. Thanks so much. Any parting bits of advice for the folks that are here 2 hours and 17 minutes in?
This is just really, I just want to acknowledge you. You've been doing this for a long time and gone through some stuff and really built an extraordinary audience. Where else can they spend 2 hours and 17 minutes really kind of in this deep kind of Q&A with different investment managers? I mean, maybe 30 minutes, 45 minutes, they get to hear the pitch, but then to really drill down and get to know the asset class and the manager and all that stuff, that's a really unique service that you're providing to everybody. And it's a really unique audience who wants that. So just kudos to you, kudos to your audience. Glad to participate with you guys on both sides as an audience member and in front of the camera too. So thank you.
That's very kind. I will push the props straight onto the audience. This is Thoughtful Money. It's a thoughtful audience. I simply just do what they tell me they want to see more of. So it's all good, but you're right. It's completely the people here. So anyways, folks, thanks for making it through with us here. Again, if you've got further questions on the opportunity here, follow up with Craig and the Farmland LP team at the links that he mentioned there for you. And I will be sending you tonight the replay video of this presentation along with a link to the slides.
Great. Thank you, Adam. Thanks,
everyone. You too, my friend. And with that, thanks so much for watching, everybody. We'll see you on the channel soon.